Today we'll be discussing the different types of ownership, and then we'll talk about buying an existing business. In order to start with this, first thing we'll discuss is things which to be considered when starting a business. Then we'll be discussing the proprietorship, then partnership, then corporation, then limited liability company. Then finally, we'll be discussing buying an existing business. So, we should start with the things to consider while starting a business. The following are the most important issues entrepreneurs should consider when they are evaluating the various forms of ownership. First is the tax consideration. That means the amount of net income an entrepreneur expects to get, and the tax bill the owner must pay are important factor when choosing a form of ownership. Second is the liability exposure. That means that certain forms of ownership offer business owners greater protection from personal liabilities that might result from financial problems, faulty products, lawsuits, and a host of other difficulties. It means that while we are considering a business ownership, we should see that whether there are any lawsuits or there may be any product problems or deficiencies, or maybe there are certain financial problems, and what other difficulties we may come across if we accept or we start this business. Another important thing is a startup and future capital requirements. Forms of ownership differ in their ability to raise startup capital. You know, as we discussed earlier also, that if you are in a business where you have to start a manufacturing unit, and that manufacturing unit needs more capital than if you are starting a service unit. So we'll similarly have to keep in mind that if we are starting an ownership with proprietorship, it needs less money maybe initially, and if we are into partnership or in other form of ownership, we'll need more. So we must make an evaluation of ourselves that what suits us more. Then we talk about the control. Control means that an entrepreneur must decide early on how much control they are willing to sacrifice in exchange for help from other people to build a successful business. It means that you'll have the control you have on the things in your business and how much you'll be sacrificing or giving to the managers or other people who are in business with you. Then we talk about the managerial ability. Entrepreneurs must assess their skills and abilities to manage a business effectively, because it is very important that you evaluate your own self. You assess that where do you stand? Can you run this specific, for example, proprietorship, or it will be better for you to go for partnership, have somebody else also with you in the business? These things are to be done or considered beforehand, before starting business. Then we talk about business goals. Business goals like how big and how profitable an entrepreneur's plan for the business to become influences the form of ownership chosen. For example, what is your business plan? How much profit you are expecting to earn? What is the rate of return you are expecting on your investment? So, these things must be kept in mind. Then we talk about management succession plan. Management succession plans means that when choosing a form of ownership, business owners must look ahead when they will pass their companies to the next generation. That means you make a business, you start a business, you establish it, and then you look forward that maybe you are going to give this business to your offsprings, like your children who are going to take up the business. Cost of formation. Some forms of ownerships are most costly than the others. An entrepreneur must weigh carefully the cost benefit of a form of ownership chosen because unless you are clear about the cost and benefit, you cannot make a correct decision for forming any ownership. Now we talk about sole proprietorship. Sole proprietorship is a business owned and managed by one individual. It is the simplest form of business ownership. There are certain advantages of proprietorship. Similarly, there are some disadvantages. Let's talk about the simple advantages first. It is simple to create, least costly form of business ownership to begin. Profit incentives are there, total decision making, authority is in the hand of proprietor, there is no special legal restriction, and it is easy to discontinue. Then we talk about the disadvantages. The disadvantages of a proprietorship are limited skills and capabilities. That means that obviously, when just one individual is running a show, he or she has some restriction, some limitation on these skills. Similarly, the capabilities are also less. You start feeling isolated. So, feelings of isolation is also there. Then limited access to capital. Limited access to capital means that with your resources, maybe you are not capable of making or generating more capital or raising funds. Rather, when you are working as a partner or in a corporation, you have more access to capital. Then, lack of continuity of business. This is another very important factor. The continuity of business in many proprietorship, like it is compromised, and you cannot continue your business for a long time being individual. You have the problem. Maybe for about 5 years, 10 years, you run a business. You may come across such problems like financial problems. Now, let's see the second type of ownership, that is partnership. An association of two or more people co own a business for the purpose of making a profit is called a partnership. Obviously, while we are in business, our first aim is to make profit. So, in order to do that, if there are more than one people, then the chances are that they will be able to make more profit, they will be able to generate more capital also, more revenue also. Then we talk about the partnership agreement. It is basically a document that states in writing the terms and conditions under which the partners agree to operate the partnership and that protects each partner's interest in the business. Obviously, when there are more than one people who are wanting to run a show, run an organization, they must write a document so that the conditions about the responsibilities, profit sharing, about the capital involvement, about the investment, about the other things like who will be responsible for the financial affairs, who will be managing the manufacturing or the trade side, who will be responsible for the marketing. All these things are to be very clearly written. And in this way, each partner's interest in business is safe, or protected. The advantages of partnership. First thing is it is easy to establish because if there are two or three people, they can put in a maybe in some cases same amount. In some cases, there can be one person who is financing, the other one is executing the business. So it is easy to establish. Then we talk about the complementary skills. That means the skills complement each other. One may be good in accounting or financial side, the other may be good in the marketing side. And if there is a third person who is very good with the computer side, these people can divide their area of expertise, and in this way they together come up with a stronger skills and ability. Division of profits, obviously, if there are more than one people, the profit has to be divided, and it is clearly written in the agreement, so there should not be any problem in it. Larger pool of capital means that there is more chance of making the capital available. That means when there are more than one people, they can easily accumulate more capital than just one person. Then ability to attract limited partners, that is how they can attract more partners because the partnership says that there will be, for example, company limited to just four people, and they say that we don't want to go further because we'll have to then divide our profit in more and more small pieces, and maybe at the end of the day nobody will be happy with the total profit. So the ability to attract limited partners is also important in partnership deal. We say that general partners are those who participate in the overall partnership, and they do both financing as well as the execution. Whereas when we talk about limited partners are those who are only maybe a person is limited to the financing side or investor, and the other partner is the executive side, or you say that the person who will execute the partnership. Thirdly, there are silent partners. Silent partners are those people who maybe are the members, but they are not active. And finally, we talk about the dominant partners. Dominant partners are actually neither active nor people know them as member of that company in one way or the other, being partner of the company but not active. When we talk about limited partnership, we actually are talking about the partnership with limited numbers. Like we already discussed in our agreement that only three or four partners will work. If there are more, then they will have problems also. Another important aspect of partnership or advantage is the minimal government regulation. In partnership, there are little government regulation. It is not very lengthy law and government regulations which you have to deal with. Flexibility, of course, your partnership deals are flexible because one can like overshadow each other. Taxation in partnership is more than that of proprietorship, but in this case, the tax is being shared among the partners as being part of the company. Now, let's see the disadvantages of a partnership. Unlimited liability of at least one partner. It means that in many partnerships, it has been seen that the working partner or the executing partner had usually more liability than the financing or the silent partner or the partner who is just supportive. Another drawback or disadvantage of partnership is capital accumulation. When it comes to capital accumulation, since it is being placed on the head of one person, so he, in some cases, or she, in some cases, is not capable of accumulating sufficient capital. As a result, he or she is then creates difficulty for the others. Now, another important thing is difficulty in disposing of partnership interest. When we say that difficulty in disposing of partnership interest, it comes to the point where the disagreements start between the partners or among the partners, and this one of the partners says that I am taking more responsibility whereas my profit share is low. So what we have seen that if a person who is arranging the finance and it is on his personal guarantee or her personal guarantee that the bank has given loan to the organization or this company, he or she will feel unrest when it will come to or feel discomfortable when it comes to the interest level that the profit margin turns out low for this person. Another important thing is potential for personality and authority conflicts. It is something very important that if you are in a partnership business that you have to be very balanced with your other partners. Otherwise, the conflict of authority or the personality conflict takes place. Authority conflict comes when the managing partner says that I am running the show and I am the one who is actually doing all the business. Whereas the financing partner would say that I am arranging the finance, I'm the one who has taken his personal life or the dignity on stake. So these sort of problems give a lot of problem, or it becomes sometimes very difficult to carry on with the partnership. Limited liability partnership means that the partnership should be limited so that the liability of each person who is involved in this partnership should be under control, should be a sort of what you call it, the balance in the partners. Now let's talk about the corporations. Corporations is a separate legal entity apart from its owners that receive the right to exist from the state in which it is incorporated. For example, there are different states or different provincial laws which apply to corporations. So the corporations are basically in four forms. Closely held corporation is mainly a corporation whose shares are controlled by a relatively small number of people, often family members, friends, or employees. For example, a group of family or five or six people from a family, they make a company and they make it a limited company, which we call the private limited company. These private limited companies are actually corporations where each member of that family holds a specific position, as one maybe the father may be the chairman, whereas the elder son as managing director, and then the other sons and daughter, they become directors depending on their experience, their level of degree or study. Second type of corporation is publicly held corporation. This is a corporation which has a large number of shareholders and whose stocks usually is traded on one of the large stock exchanges. These are also called public limited companies. These public limited companies or this big corporation is actually has the right to run or sell their shares in the stock exchange, and they stand a good position. And in this company, it is not necessarily that the company is run by a family. It will be running by a group of directors known as the board of directors. And then there are managers in each section or each department of the company. So these are big organizations. The C corporation is actually also traditionally a legal form of incorporation. C corporations are usually those big corporations which run their shares in the market, and generally it has government and public representation. These companies or C corporations have one disadvantage also, that is the double taxation policy. Because a person in C corporation will have to pay a tax at the rate of corporate tax. So whatever profit they get, they have to pay tax on that, as well as a profit on the dividends which they receive as an individual. So there are two types of taxes which they give, and this is called double taxation. Actually, a disadvantage of a corporation form of ownership in which the corporation's profit are taxed twice: corporation tax, and secondly, each individual stockholder will pay a tax on the dividends which they receive. The S corporation is a corporation that retains the legal characteristic of a regular C corporation, that is, maybe a public, private, limited corporation or company, but has the advantage of being taxed as a partnership if it meets certain criteria. These criteria are being set by the government department. Now, what we say in any corporation, or rather in any organization, it is better to have this one third, one third, one third rule of thumb. A guideline that calls for an S corporation, it passes to other entities also, to distribute one third of its earnings to the shareholders to cover the taxes they owe, retain one third to fund its growth, and earmark one third for paying down debts, add to funding growth, or distribute to shareholders as a return on their investment. This rule of one third or 33% each is actually a guideline, which means that each corporation should keep one third or 33% of the total for the shareholders in the shape of dividends, 33% to be given to the banks or the financial institutions who have given them any type of loan, or who have given them any type of funding. Third is they must keep at least 33% of all this for the growth of the company, so that if they have to purchase new machinery or they have to purchase more of raw material in order to expand the business, they should use 33% of it as well. Now let's talk about the limited liability company. Limited liability company is a form of ownership that, like an S corporation, is a cross between a partnership and a corporation, because the limited liability companies have a clear cut articles of their organizations and their operating agreement, which they get approved from the government or the law institutions or the company's department. There's a government department called the company's legal department. So, article which this company has to department is actually a document that creates an LLC by establishing its name, address, method of management, line of business, its duration, capital. Capital means working capital as well as fixed assets and other details. So, in an article of organization, a limited liability company writes down all the details which are required for establishing a company. That means the name, address, the mode of business, how this business will be managed, what are the lines of product, then what will be the duration of this company, then the basic capital required, the working capital or the variable capital. It also talks about the fixed assets like building, like the factory premises or the land used for this matter. So all these things are to be made clear in the articles of organization. Then we talk about the operating agreement, the document that establishes for an LLC the provisions governing the way it will conduct business. Operating agreement means that the position of managers, directors, and the other staff is to be made clear. The line of business should be made clear. The responsibility or position of each of the directors should be clear so that all this to be written in a document, and that document also has to be submitted to the government, to the banks, wherever you need like financial assistance. So the financial institutions, for legal matters, it has to be submitted to the legal department of the government.